while the Chinese policymakers coming out of the two sessions haven't said whatever it takes, if you will, I think setting a 5% GDP growth target and while lowering that inflation expectation suggests that they're going to be very supportive. You know, the market was expecting maybe larger fiscal spending and special bonds. It's also not clear whether the headwinds from the tariffs, U.S. tariffs, is playing into that target yet. So there's maybe a hope that there may be extraordinary measures announced. One thing that's clear is that the private sector is back in focus as a potential lever for growth for the Chinese economy, which then plays to your question about high yield, plays to the benefit. And the markets reacted quite positively, both onshore and offshore. To the extent that these growth expectations manifest, you're likely to see Chinese rates also react to that by rising. And you've seen some of that already happen this year, not meaningful, but you've seen sort of the shape of the curve start to change. You've seen rates sort of back up a little bit. Our view is that you might see more steepening in the Chinese rates in the near term. Medium to long term, I think there's a lot of structural questions that remain to be figured out around demographics, the debt levels, the economic rebalancing that needs to go through the Chinese economy. I think the good news is that maybe a lot of people draw parallels to what happened in Japan 3 or 4 decades ago. I think there's differences. There's parallels and there's differences. I mean, what I laid out for you are sort of the parallels, but the differences are that the pace at which the policymakers are dealing with these issues seems to be significantly faster than what we saw maybe in Japan.
And hopefully we won't face a lost decade like Japan. You were talking about larger fiscal spending. We're certainly getting that in spades from Europe, and we saw yields over in that part of the world all hot and bothered last week by this renewed push to try and look after their own their own defence needs. What does that mean, do you think, for investing in fixed income in the Eurozone?
Look, I think firstly, global fixed income, I would say the volatility is to be taken advantage of. Unlike equities, which are about growth and hope, fixed income is about getting paid. It's clear to us that I think the price pressures in Europe will continue to motivate ECB to have an easing bias in the medium term. So what that means is maybe the curve steepens a bit further, especially as various countries come in to borrow to support their fiscal growth picks up, hopefully, on the back of it. So I would say I think the broader view that we have is in this regime where volatility is higher, because everyone's hanging on to every single data point, you're supposed to take advantage of it. When you feel like the yields are getting to a level or spreads are getting to a level where where you feel like you like what you're going to get paid. Whereas in equities, you're not even sure what you're going to get paid. Today, we like fixed income. Coming into this vol event, if you will, around fiscal, monetary, as well as some of the macro data points that you touched on, spreads were not cheap by historic standards. So you had to look for pockets where there were opportunities. So certain parts of the securitized market in global fixed income was wide. Certain parts of Asian fixed income, for example, was trading a bit wider. China, you touched on a little bit, but there's other pockets that seem to offer some value versus other segments of the market on a relative value basis. I think as you look forward, given the benign outlook that we have for credit quality issues, whether it's investment grade or high yield, I think you're supposed to buy carry, performing income.